Hello and welcome to the Business Standard Morning Show. I'm Veenu Sandhu. Let's take a look at the stories for the day. The Indian rupee continued to depreciate and hit an all-time low of 81.63 against the US dollar on Monday. This is despite the central bank's efforts, which spent close to $100 billion to stem the fall, easing of commodity prices and return of foreign capital. Experts say that the fall in rupee is in line with the massive fall in global currencies against the US dollar. Even though the falling rupee does not spell bad news for all the sectors, what will be its implication? Let's find out.
The Indian rupee sank to a new record low on Monday against the US dollar as the greenback's unabated strength wreaked havoc on financial markets across the globe amid fears over more aggressive monetary tightening. The local unit weakened by 63 paise to end Monday at 81.63 per dollar against 80.99 at the previous close. The rupee has depreciated 9.7% against the US dollar year to date. On September 21st, the US Federal Reserve not only hiked rates by 75 basis points, taking the total tally of rate hikes since March to 300 basis points, but also hinted at a longer monetary tightening cycle than earlier expected. Since then, the rupee has gone from one of the world's best performing currencies to one of the worst. The dollar index, which has gained a massive 22% so far in 2022, surged to a fresh 20-year high early Monday. The rupee has depreciated 2% versus the dollar since September 21, ranking among the worst performing emerging market units. Over the time period, it has fared worse than 14 other emerging market currencies, with only the South Korean won losing more versus the US dollar. Prior to September 21, the rupee had outperformed many of its peers, primarily on account of heavy market interventions by the RBI. The RBI has aggressively defended the rupee through sales of US dollars since the Ukraine war broke out in late February. India's forex reserves have fallen by almost $100 billion from their peak of $642 billion in October 2021. As on September 16th, they have dropped to a near 2-year low of $545.65 billion. Some part of the fall in reserves is due to revaluation changes. The import cover provided by the reserves have reduced to 9 months from close to 15 months a year ago. Let us go to economist Rahul Bajoria for more.
Our expectation since the month of June still remains about $115 billion of current account deficit for this current fiscal year. Now, the drivers behind that continues to be, India's relatively strong growth profile. So you should see some correction in the trade deficit in the next few months, but then it will still ensure that, we will have a overall current account deficit, which is north of 3% of GDP, which is what, is seen as a sustainable level. Commodity prices in local currency terms are still about 20% lower from its peak levels. But then what we are not seeing right now is basically the pass-through of these lower imported prices into retail prices, right? Both private companies and the government will try to recoup some of the losses that they have had. So, you can think about it as that earlier when prices were going up, there was margins were contracting. Now the margins are again widening, but eventually it will start getting passed on. So we think that next 3 months, that bulk of that pass through should sort of come through. In the final quarter of this calendar year, so basically October onwards, we will see inflation coming back within the target band of the RBI.
The rupee dropping to a record low may be a mixed bag as far as exports are concerned. If rupee's depreciation continues, Indian exporters stand to gain. However, the gain would have been much more if the Indian economy was less import dependent, experts said. As a result, products across segments such as petroleum, gems and jewelry, and electronics may not gain much as they are import dependent. Besides, there is always a risk of imported inflation if the rupee falls too much. As India is 85% dependent on imports to meet its oil needs, a weakening rupee will make its purchases expensive, further fueling inflation, which has remained above RBI's upper tolerance band for 8 consecutive months. But oil and other commodity prices have eased from their peaks. Nevertheless, ICRA's chief economist Aditi Nair said that a depreciating rupee will partly counteract the benefit of lower commodity prices on inflation. India's trade deficit more than doubled to $28 billion in August due to increased crude oil imports. Imports rose by 37%, while exports rose marginally by 1.62%. This puts pressure on the current account deficit. Pranab Sen, noted economist and statistician, tells more.
The reason I think the RBI thinks that what is happening is a temporary phase is because I think they do expect the global prices to come down. And so what they're trying to do is they're managing the rupee to avoid a situation where commodity prices come down, but you've depreciated so much, the landed price in rupees has actually gone up. So the whole thing, both the decision to manage it is contingent upon your expectation that commodity prices will come down, and we just have to ride over until they do. Right? But there is another dimension, which is that today the current account deficit is running above 3%. So that seems to suggest, and this is not just a price problem. There's a problem with volumes as well. Import volumes are high. And that is a more structural problem, and that may not necessarily be temporary. So you have to segregate those two issues. How much of your current account deficit is driven by high commodity prices, which will come off later. But how much of it is being driven essentially because you're importing too much. For that, you need the rupee to depreciate.
Economists at HDFC Bank expect the RBI to continue with significant intervention to stall rupee depreciation pressures, especially as and if it moves towards 82 levels. According to them, the RBI has ample forex reserves, and the recent drawdown in reserves needs to be seen in the context of the significant build-up over the last 2 years. The RBI does not want the rupee to depreciate so quickly that India loses out on the benefit of lower crude prices in a significant way. But most currencies, including rupee, have depreciated due to dollar strength. There may be an argument, therefore, to let the rupee depreciate further to preserve India's export competitiveness relative to its trade competitors. The central bank has a tough balancing act on its hand.
May also blunt the benefits that India may have enjoyed from the recent correction in commodity prices. So relief on petrol and diesel prices is unlikely anytime soon. Of late, the price gap between petrol and diesel has been narrowing. The price advantage that diesel enjoyed fueled the rise of diesel vehicles in the country. But the edge is waning, and BS6 emission norms have dealt another blow to the sales of diesel vehicles. So what is in store ahead for diesel cars in India? Watch our next report for the answer.
Indian roads were once dominated by four-wheelers propelled by diesel engines, and for long they have been the preferred choice of Indian consumers. However, with the push for electric vehicles and stricter emission norms, the outlook is looking bleak for diesel-powered cars. As the new BS6 emission norms kicked in 2020, many car makers trimmed diesel engine vehicles from their portfolio. India's biggest car maker Maruti has completely discontinued diesel models. Tata Motors has discontinued smaller capacity diesel engines. Honda India recently said it would most likely discontinue its diesel engine cars. At present, Honda offers diesel variants of City, Amaze, and its Jazz premium hatchback. Other car makers like Volkswagen, Skoda, Nissan, and Renault have also reduced diesel portfolios. Compared with petrol vehicles, car makers have faced many problems with upgradation to new emission standards, and the costs shot up. Come March 2023, a new phase of emission norms will kick in, and this is further making car makers wary of diesel engine cars. Maruti had earlier said that the second phase of emission norms will further raise costs and impact sales. Under the second phase of BS6 norms, vehicles must meet emission norms in the real world as opposed to a laboratory. The focus will be on increasing fuel efficiency and, in turn, reducing emissions as well. Diesel engine vehicles commanded a market share of over 50% in the passenger vehicle segment in 2012-13, but it has reduced drastically over the years. It has come down to 18% in FY22, according to data from Federation of Automobile Dealers Association. The drop has been sharp, particularly since the BS6 emission norms were introduced in 2020. The market share in the PV segment almost halved from 33% in 2019. However, the rise in sport utility vehicles is giving a lease of life to diesel variant engines. According to industry estimates, the share of SUVs in overall passenger vehicles has risen from just 18% in 2016 to 40% in FY 2022. According to analysts and automakers, consumers prefer diesel engines in SUVs as due to their relatively higher pulling power at low engine speeds, making it an easier and quicker takeoff from the go. According to reports, the sales share of diesel engine variants is 35 to 40% in compact SUVs, 55 to 60% in the mid-size SUV segment, and even higher in the large SUV segment. But the overall picture is not good for diesel variant engines. Apart from the stricter emission norms, the surge in electric vehicle sales has also spelled doom for diesel engine cars. Niti Aayog has set a target of EV sales penetration at 70% for all commercial cars, 30% for private cars, 40% for buses, and 80% for 2- and 3-wheelers by 2030. The narrowing down of petrol and diesel prices over the last few years has further reduced diesel cars' appeal as the government reduced subsidies on the diesel. So is it the beginning of the end of diesel in India?
When we look at the long-term data, the share of diesel and passenger vehicles in the overall mix has come down, meaningfully when we compare, the same data 8 years, 10 years back, probably. However, I think we need to have a look at different segments within the car industry as well. Now, for instance, when we look at the entry-level passenger car segment, that is mainly dominated by petrol-run vehicles. If you look at the compact and the mid-size segment, there is some portion of diesel sales still happening. So I think we have seen the trend of share of diesel cars coming off a few years back, but in the last 2 to 3 years, we actually have seen it, being range bound and has stabilized at certain levels now. So some segments, if we'll see in the near term, will likely continue with diesel engine option over the near to medium term. Eventually, the trend over the longer term is shifting towards cleaner fuel.
Some automakers still see a future for diesel engines. Diesel is still a major component of automakers like Mahindra, Toyota, Jeep, and Kia due to their SUV, MUV crossover product portfolio. A Toyota official even went on to say that diesel demand is stronger than ever in India. Mahindra too echoed the same sentiment recently. Hyundai is still seeing a strong demand for diesel SUVs. The share of diesel variants in the overall sales mix at Hyundai rose to 27.4% in the first 5 months of the current calendar year. An outright exit for diesel may not happen anytime soon, but as India shifts towards cleaner fuels, the engine's appeal may dwindle further.
Moving on, the market sentiment has turned negative after the US Federal Reserve delivered a third large rate hike last week, with over half of Nifty 500 stocks slipping below their key moving averages. So is this fall set to continue, or is the recent selling an overreaction? We break this down for you in this segment.
Since the US Federal Reserve hiked rates by 75 basis points last Wednesday, the Sensex and the Nifty 50 indices have tumbled nearly 4% each, turning negative in terms of returns for 2022. As per technical charts, over half of the Nifty 500 index constituents have been dragged below their respective 200-day moving averages with the recent sell-off. Technically, the 200 DMA provides a broad outlook of the underlying trend in a stock or an index for long-term investors. Traders prefer stocks and indices that are above the 200 DMA since they tend to perform better over time. Analysts, however, say this correction has been overblown due to panic selling by investors.
In Indian market, it is over there, certainly, because this is what happened last 3 times. Whenever there was a pain in the global market, whether it was a dot-com originated there, then Lehman crisis originated there, deflationary conditions early 2016, Jan, February originated in the Western world, COVID also originated outside India. So all 3-4 occasions, Indian market was also penalized a lot, and then Indian market bounced back a lot. And in all 4 conditions, one thing was very clear: the India's GDP growth never got into negative territory. Most importantly, with the latest hike in the interest rate in the US Fed, US also crossed, around 65% of the targeted interest rate hike. So again, the lot of data point prove, even for US market, that just 1 or 2 months before the Fed rate peaks out, the markets start rising, and markets have given a phenomenal return even in the US. So I am pretty confident that with the good monsoon, decent Kharif output, because a double-digit deficit was there in Kharif area. As of today, it is just 1.6%, and tax collections, oil price crash, all this would augur well.
Sharing similar views, VK Vijay Kumar of Geojit Financial Services says, despite an unfavorable global macro construct, in the short run, the Indian markets will outperform their global peers. Vijay Kumar says, with the Fed staying ultra-hawkish, the 5% slide in the MSCI World Index last week reflects the bearish undertone of global equities. However, India will outperform both in economic growth and market performance. Selective buying can be done in domestic economy-facing segments like financials, auto, capital goods, and others. That said, the Sensex and Nifty indices slid below their 50-day moving averages on Monday, and the duo can continue the slide on breaching the key support levels of 200-day moving averages, as per technical charts.
After holding the selling spree at 50 days moving average last week, the Indian benchmark indices further declined on Monday, negating that support. BSE Sensex and Nifty were seen trading 1% lower and continued their 4th losing streak. At this point of time, the next support for Sensex and Nifty comes at 200 days moving average. For Sensex 57,000 and for Nifty 17,000 are the 200 days moving average. And with the selling pressure on Monday, we have seen altogether 268 stocks losing their ground below 200 days moving average. 37 stocks were added on Monday itself. And both the indices loses ground below their 200 days moving average. Sensex could fall to 56,000, whereas Nifty can slip to 16,700 to 16,800 levels. Among Nifty 50 stocks, we have seen HDFC Majors, HDFC Bank, HDFC and Reliance, as well as PPCL losing further ground. Among Sensex stocks, Power Grid, TCS, Wipro, Tata Steels were losing their ground below 200 days moving average.
Today, global market trends, FII inflows, rupee dollar levels, and oil prices will dictate the market trajectory.
SEBI recently issued guidelines for stockbrokers who provide algorithmic trading services. And its chairperson, Madhvi Puri Butch, said last week that the regulator was not for or against algo trading as long as there is transparency and disclosures. Now, what exactly is algo trading? This report explains.
Any market investor's typical trading day involves keeping a track of the market and placing buy and sell orders depending on the time, volumes, and analysis. It has been going on for decades now. But technology is changing the way we used to trade. It has given a better alternative to manual trading. Investors can simply write an algorithm that includes specific trade instructions, and then the trade is automatically generated by the system. An algo-trading is typically defined as execution of trades by feeding predefined instructions or programs to the computer. Algorithmic trading uses historical information and data to execute intelligent and better trades. For instance, if a trader wants to buy 1,000 shares of an IT company when it touches 500 rupees and sell the shares when the stock hits 550 rupees, he can simply feed these instructions by writing a computer algorithm. As soon as the stock price hits 550 rupees, the trade will be automatically executed. In this case, it is not required for the trader to track the stock price all day long and execute trades manually. Here, the trader used stock price as a metric, while there could be numerous other instructions like moving averages, volumes, etc. Algo trading makes it easier for traders to reduce human errors and execute time-saving trades. It also takes complex human emotions, which can hamper the effectiveness of trade, completely out of the equation. Investors often miss critical trades as the price movement is very fast. In some instances, the stock movement is so volatile that it can change the entire nature of the trade. With the help of algo trading, trades are timed correctly to avoid significant price fluctuations. Algo trading can execute trades which are almost impossible for humans. The rise of algorithmic trading has led to a significant drop in transaction costs. Some trading strategies can also be back-tested using real-time and historical data to see if they are viable options. Institutional investors like mutual funds use algo trading to make massive purchases of stocks. As it gained popularity, most retail traders have also joined the bandwagon and started employing algo trading. Besides increasing chances of making higher profits, algo trading ensures more liquidity in markets. While globally 70 to 80% of market volumes come from algo trading, in India, the figure is somewhere between 40 to 50%. As volumes rise, there are some concerns that brokers are luring investors by claiming these cutting-edge technologies would generate higher returns. Market regulator SEBI recently asked algo trading services to not mention any reference to past or future returns.
Backed by the nation's trusted bank, SBI, the banker to every Indian.
SEBI's intervention came amid reports that several brokers were promising high and guaranteed returns to investors from algo trading. The regulator said that these claims were misleading. Zerodha co-founder and CEO Nitin Kamath too said that there was a misconception that algorithm trading offered guaranteed returns. That's all for today. For more news and analysis, please log into our website www.business-standard.com, and we'll also be back tomorrow morning with more. Stay tuned and thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.